Good morning, ladies and gentlemen. Thank you for joining this webinar on banks. I hope everybody is making good money from the market and continue trading with UOB Kay Hian. So without further ado, let me start with the session. So if we were to move on to the first slide, you can see that we have a market weight on Malaysian banks. Essentially, we have a neutral call. You can see from the chart, Malaysian banks have actually underperformed the KLCI, and if you look at the right-hand side chart, 19.4% down, KL Fin Index, and CIMB is the largest, the worst performer, and Hong Leong Bank is actually the best performer on the relative basis. The key reason for the underperformance, as we all know, is unprecedented times. NPL is still very uncertain, and with the loan moratorium in place, nobody really knows the real impact of the NPL scenario. But nevertheless, this session, what I'll try to do is to give you a sense of past crises and the correlation in past crises between how the sector has performed past crises, how to position yourself, and what to expect post moratorium, and to see whether the banks have really baked in sufficient forward-looking provisions. So on the second slide, you can see I've put up two charts here. One is the KL Fin Index performance during the GFC crisis versus net profit, and the other chart is to show GDP versus KL Fin Index. You can see that there is a very strong correlation between KL Fin Index and GDP in the last crisis. The KL Fin Index actually troughed in third quarter 08, and that was in line with GDP trough in third quarter 08. But I think you have to see that there is one very different factor now versus the past crisis. Firstly, during GFC, the Malaysian banks were not really affected. Unemployment rates did not even spike up. And if you look at the banks, they were even in a stronger position. But nevertheless, what is important to see is that if you look at 2020 and 2021, 2020 we are forecasting minus 3.5% GDP contraction. Bank Negara is looking at minus 3.5 to minus 5.5, and unemployment rates at 4.5. Moving into 2021, we are expecting a sharp spike in GDP recovery from 5 to 6%, and Bank Negara in fact is looking up to 8%. So theoretically, banks being a proxy to the economy should recover in 2021. But that said, the market remains on a wait and see mode due to the masking effects of the loan moratorium and asset quality trends. And I think key milestones to note, if you move on to the next slide, what we want to highlight is that, there are three key milestones. The first milestone is the ending of the automatic loan moratorium on 30th September. The second milestone is the ending of the targeted loan moratorium on 31st December. And the final milestone is the ending of the R&R, the restructuring and rescheduling, that ends on 31st March 2020. So I think, the market is not going to really be too optimistic about the banks until these three milestones have passed. And hence the market can really start to assess what is the real impact of the provisions and NPL once these three milestones is passed. So I think, just to give you a sense of the unprecedented nature of the current scenario, the government has come up with this wage subsidy scheme. And so far, 2.6 million workers have taken this scheme, and that's equivalent to 16.5% of the total labor force. So this is no joke. It's a significant amount. And how this scheme works is that it's a 6 plus 3 months from the first payment. So the initial the wage subsidy was 10.4 billion, and that was 6 months from first payment. So it started in 1st of April. So it depends. A company can start the wage subsidy in May or June, and then it ends 6 months from when you first took the first payment of the wage subsidy. And if you monitor the news, just about a few days ago, Muhyiddin has come up with a statement at the government saying that they are going to add another 2.4 billion to the 10.4 billion. So that shows that the situation is it's quite serious. The initial 10.4 billion taken up by 2.6 million workers may not be sufficient. So we would like to also monitor. The unemployment rates are now at about 4.7%, and this is even with the wage subsidy in place. What happens if the wage subsidy ends, and then we have this second wave of COVID, and the vaccine the vaccine is delayed? There is a risk that if the government do not continue with this wage subsidy and we have a serious second wave of COVID, the unemployment rates could go back up. And hence, moving back to the previous slide, I just want to highlight our forecast is for unemployment rates to come down to 3.7%. Is premised on the assumption that there is no sharp second wave. So you have to take that account. Now is really anybody's guess. So that is our base case assumption now. So I think we want to take a wait and see attitude. This wage subsidy should end, I would say, anywhere between end of December to March of next year. If the situation is worse, the government, I feel, to tame the unemployment rates will have to continue this wage subsidy. So it will put some slight strain on the physical discipline of the government. So I think these are the 3 key milestones. We estimate that post automatic loan moratorium, around maybe 20% of system loans will require some form of targeted loan moratorium. You see on the chart on the right, countries like Singapore is about 10 to 15%. In Philippines is 20%. These countries don't have an automatic loan moratorium. So what you see there is really the true nature of what the moratorium will be, assuming if Malaysia don't have an automatic loan moratorium. So I think you take an average between a developed country like Singapore, 10 to 15. Thailand is it's quite high, 20 to 30%. So I think the average the moratorium will be about 20%. That's pretty high. If you look at pre-COVID, the normal level of R&R is only about 2%. So assuming if it goes to 20%, it's a 10-fold increase of the normal run rate. So that's why I think the market, the banks are not really performing as a market wants to take a wait and see approach. So move on to the next slide. I think before we talk about, we delve closer into what the provisions would look like. Maybe I want to just share with you, maybe on an educational basis, how this asset quality under FRS 9 works. So if you look at the next slide, I think asset quality, I think this is a bit theoretical, but I'll just run through it. Gross impaired loans ratio is impaired loans divided by gross loans. Loan loss coverage is allowance for impaired loans divided by total impaired loans, and the other is loan loss coverage ratio. You can see on the right hand side chart, very important is that what you notice is that the GIL ratio, okay, of the consumer-centric banks like Public, BIB, and Hong Leong Bank is lower than the corporate-centric banks, loan-centric banks. It's because they don't have lumpy corporate NPL. That's one thing to highlight. The second thing to highlight is that you look at the consumer-centric banks like Public and Hong Kong Bank and BIMB. You notice that their loan loss coverage ratio plus R&R is very high. Public's at 301%, Hong Kong's at 184, BIB at 205%. Why I want to highlight this is because my feel is that if assuming unemployment rate does not spike up, okay, it stabilizes and gradually improves as the economic reopening theme pans out. My feel is that the consumer-centric banks, in terms of share price performance, could outperform the corporate-centric banks in the early stages of the recovery. Two reasons for that is, one is that, if unemployment rate is stable, what it means is that people still got their jobs, NPL will be more manageable, and hence they don't have to build in so much provision, number one. Number two, because if you look at their loan loss coverage ratio, it's already very high. And coupled with the fact that if unemployment rates are not spiking and their NPLs is more muted than expected, coupled with their high LLC, means really there is downside risk to what market is building in terms of provisions expectations for the consumer-centric banks. While your corporate-centric banks, because there is still going to be structural impact, this COVID-19, what I call new norms, to the impact of certain business models, and this will take time to play out in terms of NPL, because the government, Bank Negara, has allowed banks to do R&R, unlimited R&R, all the way until 1st March of 2021, and possibly extending it into first half of 2021. So your corporate NPL could, there could be a masking effect on the real health of the certain corporates NPL all the way until delayed all the way until first half of 2021, and it will only start to really unfold itself into the second half of 2021. So there could be a delayed effect in terms of the true asset quality picture of your corporate centric banks, NPL corporate centric banks. While your retail centric banks, the unemployment rate is already, to me, a very, very good leading indicator of what the NPL will be. So I move on to the next slide. FRS 9 is very pro-cyclical. You got stage 1, 2, and 3. A bit technical, so I'll move on to the next slide. Assessing the level of provisions booked in. These slides just want to show you that, under FRS 9, even stage 1 and 2 provisions, if you look at column 1, 2, 3, 4, 5, 6, and 7, overall, in terms of the provisions that booked in under stage 1 and 2 loans, is only about 0.7% of total loans. If you look at the previous FRS 9, is also around so it's very low. Basically, what I want to highlight, that the provisions stage 1 and 2. Stage 1 and 2 provisions means that your loans have not turned 3 months NPL yet for stage 2, but it is more than 1 month but less than 3 months overdue. So assuming that if it moves into stage 3, the provisions that they will require to book in will spike up quite significantly. And this is shown on the next slide. You can see the formula how to calculate stage 1 is assuming PD of 1%, LGD is your loss given default, and that's essentially your loans exposure less collateral, and EAD is your loans exposure. At stage 1, it's only 50K provisions that will be built in, assuming a 10 million kind of loan. You look at stage 2, it only rise very marginally from 50 to 90K. But assuming that loan falls into stage 3 due to COVID-19, you can see that the provision can spike up from 90,000 to 5 million. So that's a significant increase in provisions that the banks have not built in. right? So that's where the concern is, that a lot of these loans that are now sitting in stage 2, the provisions that are built in is very low, and there is a significant requirement to top up provisions if it falls to stage 3. So I move on to the next slide, but you can see that banks are already building up provisions. Loan loss coverage ratio has increased. In terms of GR ratio, is still quite benign because of the loan moratorium. And this chart, I just want to highlight, the recent quarter results. The only bank that have actually shown an increase in GR ratio is CIMB, because Indonesia, they have the highest exposure and the risk in Indonesia is quite high. The next slide, I just want to show you that in terms of the bank's credit cost expectations, we have built in the highest assumption for CIMB 120, and the lowest is public bank at only 22 basis points. And in terms of credit cost versus GIL ratio, you can see that, despite the GIL ratio being quite tame because of the loan moratorium, the banks are already building up a significant increase in forward-looking general provisions. Now, this is a quite interesting slide. Basically, I did a calculation to show whether the banks have built in sufficient provisions that have baked in. And you can see here that, even for the high-risk banks like CIMB, it seems like they have baked in sufficient provisions. And I just want to show you how my calculations for these provisions are like. Firstly, I assume that 30% of the loans are vulnerable loans. And how I gather this 30% is really from Bank Negara indicated in their recent financial stability report that 30% of total gross loans could be in the vulnerable segments. And what I've done is I assume half of it is that can be contained with proactive R&R, restructuring and rescheduling, where you restructure the loans, you reschedule the loans repayment, and I assume the other half is the non-R&R, and I assume 20% of the non-R&R will fall into NPL. So if you look at these assumptions, if you assume 20% falls into NPL, what it essentially means is that I expect system NPL to triple up, from about 1.5% to 4%. This based on this scenario analysis. And and all the banks, for example, stage 1 and stage 2 provisions based on their individual stage 1 and stage 2 provisions ratio, and based on 20% will fall into NPL, then the provisions are around this level, and I assume that they fall into stage 3. Okay, and based on stage 3 provisioning, these are the provisioning top-up required. And this, the second last line is what we have baked into our assumptions. So even large banks, higher risk banks like CIB, you can see that based on this calculation or this sensitivity scenario analysis, I think that they have adequately provided. Maybank is about 32%. But of course, you notice here, you see public, you think it's there's a deficit of 42%, and so forth. And Hong Leong Bank, there's a slight deficit. But I just want to qualify that this 30% of vulnerable loan segment is just a blanket assumption, and that it may not be the case for all banks. Public bank, with the very strong asset quality, likely chance is that their vulnerable segments is lower than 30%. So say for public bank, the vulnerable segment is much lower, say 10% rather than 30%. You can see that based on the footnote I've shown below, that the total provision that may require is only about 820 million versus what we have baked in our assumptions, 1.4 billion. And the provision that we have baked in is spread across 2 years because of COVID-19 unprecedented scale. They will probably take 2 years of elevated provisions that they would like to build in. So it's, assuming there's no second wave, assuming that this scenario is fair, whereby we expect NPL to triple, we think that the market has adequately priced in a scenario of tripling in NPLs. So unless your system NPLs goes up to above 4.5% to about say 6% and above, then there could be further downside risk to the banks. So I move on to the next slide. This is to show you banks' earnings and NPL during past crisis. During AFC, it went up to about 360 basis points, but then the NPL ratio was much higher at about 18%. GFC was about 4.5%. It's about a non-event, and what we have we expect is NPL to peak at about 4% in 2021 from the current 1.4%. So I think as long as it stays within this range, we think that downside risk for the banks is fairly limited, assuming there is no second COVID wave. Move on to the next slide. We are still expecting banks to still remain profitable. I've shown you these two charts. One is the core earnings, where we stripped out the modification loss, loans modification loss, and the right-hand side chart is inclusive of loans modification loss. So you can see on the right-hand side chart, even with provisions being built in, preemptive provisions being built in, and coupled with the loans modification loss, the banks are actually still profitable, and we expect them to remain profitable unless NPL were to go above say 8%, the double of what we expect. Move on to the next slide. This is just sharing with you our earnings assumptions for 2021. You can see that we are expecting a sharp 14.9% jump in 2021 earnings, but this is from a low base because we are expecting a 22.7% decline in earnings. That said, we want to highlight that despite the 14.9% jump in earnings, our forecasted ROE for 2021 is still fairly low at about 7.7%. Before COVID is around 10% ROE. So that's why we feel the banks are fairly valued at this point of time, because at about expected 7 to 7.7% ROE, it should correlate with about a 0.8 times price to book where it's currently at. So move on to the next slide. Sector earnings drivers. We expect earnings recovery to be driven largely by a slight moderation in credit cost trends. And net interest income, you can see 4.6% increase in net interest income in 2021 because we don't expect any more rate cut, and we expect a slight improvement in loans growth, but still pretty benign at 3%, and OPEX to be quite well tamed. Move on to the next slide. The banks are coming from a position of strength, and so this is very important. Why I might say this is important is unlike what the banking crisis you saw in the US during the 08-09 global financial crisis, there was a structural issue for the banks that the European and US banks, and if you want to compare with Asian banks, you will probably be looking back at the Asian financial crisis where the banks were undercapitalized, underwriting standards were poor, but this round COVID-19 is an external factor. It's not because the banks did not manage their portfolio or the capital well. In fact, they have, since the Asian financial crisis, they've learned a lesson and they have been building buffers over that many years. So they're coming from the position of strength. So which is why the banks are holding up relatively well at about 0.8 times price to book, despite a potential second COVID wave now, is because they are at a much stronger position. LCR is about 140%. LDR, although not at the low, but at around 89% is pretty decent because we are only expecting about 3% loans growth. And this the third chart here shows that the CET1 for the sector is close to 14%. And hence this is important is because this does indicate that there is very minimal risk of the banks needing to be recapitalized. Why? Is because we still expect the banks to be profitable. We've done a stress test on the banks, and even if assuming NPLs to reach 7%, system NPLs, they should still be profitable. Coupled with a 14% average CET1, there is a very low risk of rights issue and recapitalization. So this is the positive. The banking system is coming in this unprecedented crisis from a position of strength. Next slide. I think this is on everybody's minds, dividends, because Bank Negara, I wouldn't say Bank Negara, but I would believe that Bank Negara will be cautious, and hence you saw that interim dividend, all the banks did not declare interim dividends. But I believe that this is more of a preemptive cautionary stance rather than the indication that there is issue with the capital positions or the financial positions of the bank. Why I say this is because automatic loan moratorium ends September only, targeted loan moratorium ends only in December. So it's naturally logical to assume that if the banks want to take a more cautious stance, why not wait and see until end December, to see whether the coast is clear. And then only declare the final dividend. Final dividend is typically paid out for those December year-end banks in around March. So by March, post March 2021, they should have a very clear picture of what the NPL situation will be. And hence, our base case assumption is that despite the banks not paying an interim, we still believe that they will pay a final. And based on the current share prices, you can see that the average implied 2021 yield, is about 4%. We have conservatively assumed a lower payout ratio even in a recovery year in 2021. And with that, you still get an average implied yield of 4%. In terms of CET1, RHB has the highest CET1. And hence, we think their yield could be above industry, about 4.7%. Okay, so move on to the next slide. Loans growth. This one, nothing to shout about. We think it's going to be weak, around 2 to 3%. You want to see this where I'm pointing now, the fourth chart. Loans approval rate has actually come off. Bank Negara has recently tried to relax lending measures by allowing house buyers to not cap the LTV at 70% for the third property financing. But our view is that, with unemployment rates still remaining quite uncertain, we don't think that measure is going to stimulate loans growth in the near future. In fact, banks will continue to tighten as what you've seen in the decline in approval rates. And approval rates is a leading indicator. Hence, because of falling approval rates, and you can see approval trends have turned negative, what it means is that loans growth over at least the next 6 to 12 months is going to remain very benign on the back of a low interest rate scenario. So your net interest income is nothing to shout about. It's more of the key focus now is all about NPLs and provisions, and that's why we focus a lot on asset quality in this presentation. So move on to the next slide. What to position in? We've done this screening process whereby we've shortlisted our pick on the banks based on 3 criteria. First is your LLC and your RAC reserve has to be above 100%. Means that they have given adequate provision buffers. Second is your CET1 ratio has to be above 13%. Because why? Optimally, we feel when we speak to the banks, 11 to 12% is the optimal CET1. and hence above 13%, you're very comfortable. And the current price to book valuation is close to GFC low. Based on this screening process, 4 banks have passed the test on 3 of these criteria that are Public, RHB, Alliance, and Hong Leong. The top 4 banks on this list. But we just want to qualify that because Alliance has a high SME exposure, and we think that the SME are the smaller SME versus the larger banks SME clients, so their cash flow could be a bit more constrained. So we just want to qualify that, and that's why we still have a sell call on Alliance. So if you want to position, we believe that Public, RHB, and Hong Leong are a good flight to safety, especially if you want to start going into banks now. The next slide, but having said that, sector we believe is fairly valued. I've got 3 slides here. First slide to show you during the recovery phase, the GFC, the banks actually trade up to +2 SD standard deviation. Where are we now? -2. So meaning to say that valuations, there should be limited downside because it's already trading at -2 SD. But this slide, I just also want to highlight, there is a very high correlation between price to book and ROE. The green line is your ROE and the blue line is your price to book. You can see they fall in tandem. So now ROE is hovering at about, forward 2021, ROE is hovering at about 7.7%. And hence, people want to look forward, right? So you look forward, it's all the way to 2021, and it's still at 7.7%. And hence, if you want to look at fair value based on 2021, we feel it is fairly valued. And why is ROE at 7.7% only? Is because provisions, like we mentioned earlier, likely to remain elevated. The third chart, basically, I want to show you, price to book versus ROE. And below the line is supposed to be undervalued, above is expensive. So your AMB Alliance Bank is below the line. Why we don't allocate buy in these banks yet is because AMMB, the CET1 is pretty low. They have high oil and gas portfolio. Alliance Bank is because of, like what you mentioned, high SME portfolio. BIMB, possibly you can look at it, possibly, and we have a buy call on RHB. Although Public and Hong Leong Bank is above the line, but in times of uncertainty, there's a flight to safety, scarcity premium kicks in, and these banks will remain, hence the valuation can still go up in times of uncertainty. So BIB is something also you guys can consider. They have a high LLC, a high consumer-centric loan. So if unemployment rates don't spike, I think this bank seems quite attractive. So initial phase of the recovery, you want to position yourself in the likes of RHB, Public, Hong Leong, and BIMB. Later phase of the recovery, you want that high beta kick to your portfolio. Then AMMB and CIMB are good bets. Why we don't highlight Maybank is because you can see it's above the line. It's neither here nor there. Its valuations are still trading above GFC low, and hence we think that Public would be a better index, safer index to see initial stage, and CIMB would be also a better beta recovery play during the later phase of the recovery for a large cap bank. Yeah, so the last slide is basically our peer table. We only have one buy call, but we advocate buying our weakness on the likes of Public and Hong Leong for now. Okay, I think that's the end of the presentation.
Hi, good morning, ladies and gentlemen. It's me again, Nathan here. So today with us, we have our gaming as well as furniture analyst, Jack Gore, which will be going through with us on the one portion inside the trade direction, whereby we talk about the furniture. So without further ado, let's go through what I have today for you all. So So okay, on the first slide, as you can see from here, I'm pretty sure a lot of you basically back then during my presentation in June, it was a pre-market whereby I think most of people actually make money from market. But right now, some of you, actually some of my friends also start to be doubtful and whether what should we do, what they should do right now, whether they should play a safe card or a race card. So the session today, so basically I have 100 over slides with me today, but don't worry, basically I've converted most of the contents into infographic to give you a whole holistic view on how you should position for the next 3 to 6 months. So without further ado, so just as usual, as a disclaimer here, basically we do not, just two key points to highlight here, we do not make any representation or as well as warranty or accept responsibility or liability to the accuracy, completeness, as well as correctness. So this, hence whatever we presented here should not be construed as an offer or a solicitation of an offer to purchase or subscribe or sell any securities. Okay, so for agenda for today, so what I'm going to do is that now I'm going to go through a top-down approach whereby from global perspective, I'll share with you what we have mentioned in June during my presentation 3 months ago, and how does that pan out vis-a-vis the market performance today, as well as some risk watch out for from the global as well as local stocks. Of course, we must also touch base on COVID-19 as because this one is actually the main issue that is dragging the global economic growth and hence towards the stock market performance in the next few months. Of course, we would also go through the economic conditions from global perspective, China as well as US, as these are the major countries that will affect the net exporters countries like Malaysia. So updates on the vaccine is also important. Basically, these will be precursor on how fast the recovery of the economy. Yeah. So on domestic side, of course, we'll look at the stock market performance year to date and what are the factors that actually affected the whole performance. Then detailed analysis on that and how to position for the volatility. Thereafter, we'll talk about some sectors and stock picks to position at the different phases. Of course, we will also touch base about the trade diversion winners, which is currently seeing a good growth. I.e., we'll talk about tech sector. We will also talk about the furniture sector, which will be covered by Jack in a short while. Last but not least, we'll also talk about the defensiveness sectors as well as the builders in times of uncertainty. So, look at these slides. You can see that back then, in June 2020, we actually go in contrarian of a market whereby when market is euphoria, we basically mentioned that we see some risk and see some volatility going ahead. That was during the peak month. So I also mentioned that in the next slides back then in June, I mentioned that basically CI market is only 12% away from the peak, and I did throw in some real case studies and made you all to think of whether the risk and reward is compelling back then until now. So in terms of valuation, I will showcase with, for you that basically valuation is no longer compelling alongside the weakening of our fundamental. So very much driven by liquidity, I did mention that. So small cap index as well, 18.5% away from peak back then, and risk of reward ratio is no longer as compelling. Hence, you need to adopt a cherry picking stock picking skills. Yeah. So back then, what we mentioned, basically on the key themes, we talk about the beneficiary of the COVID-19, of which we actually overweight on the glove sector and advocated a strong buy call on top glove and the rest of it. Of course, fast forward to today, even though those stocks went through a lot of volatility, you can see that if you actually hold on and ignore all the noises, you can see that the returns are actually pretty decent. Yeah. So we also talk about some growth sectors, i.e. tech, Technology, ATE, OSAT, and EMS, which perform relatively well despite the correction from the Nasdaq side. So fast forward to September right now, what you should do right now, of course, to have a holistic view, you need to actually identify the risks that are underlying the market that could be dragging the market if any of these turn sour. So as you can see on the side, concerns on second wave of infections already started to factor into the market. You can see that US, Euro side mulling about the second lockdown that could basically give the implications of a weaker economy going ahead. Even for like of Malaysia, we are actually on the verge of whether on the verge of rising cases as to compare with during the MCO and RMCO first implemented at time. So we also have the US and China trade tension. As you can see that recent cases actually on the TikTok, they are even mulling to put this SMIC, the the national wafer producing China side, to whether to put them into entity list. Looks like our very beloved Mr. Trump here still going harsh on the China side. So on the right hand side, you can see that Joe Biden as well as Donald Trump, there are of course further uncertainty over here whether each of them, some as well as I know of some of these presidents actually inclining more towards a hawkish policy. On the other hand, so basically, what they're going to do is that their policy will have a very big influence in the whole global sector. Yeah. So in view of all this, you can also see that basically the market is turning risk off. You can see that because of the inverted yield curve, also a precursor of a weaker or even a deflation weaker economy going forward, people are actually turning into a more risk safe haven assets, i.e. gold. So last but not least, we also have our own issue, which is the snap election, of which the results of the Sabah election will be the precursor of whether will there be any snap election going forward. So very quick one on the COVID-19. So back then, when we presented on the 27th of June, the case was only 9.7 million, and right now it's already jumped up by 300% 3 months time to around 32 million as of the past few days ago. So Mexico actually, you can see that US, Mexico as well Euro side actually seeing a lot of what we call the record high outbreak every day. So basically all this, if you follow all this closely, you would roughly know which are the sectors to look out for investment. Definitely border reopening theme wouldn't come in as fast, and then defensiveness yielders will still be the preference, but the very first preference will still be the beneficiary of COVID-19. Yeah. So in terms of economic condition, let's take a look at the US side. US, they have just reported their what we call the GDP numbers. As of the first quarter plunged to a negative 35%. It's actually as expected. So liquidity, you can see that the current account deficit is also widened further as the many business actually operating at a limited capacity, and some of them they even cease the operations completely. Meanwhile, movement of travelers across borders was also restricted, and hence you can see that with liquidity keep pumping the market, you can see that the current account deficit is actually widened further. So up to this point, one question that you should ask yourself is whether does that overview basically show to our overall picture that the global economy is actually slowing down and things like that? Yes and no, because if you to look at the next one, on the Chinese market. Chinese second quarter GDP already bounced back into growth, whereby you can see that from a negative 7.5%, basically jumped back to 3.2% on the latest GDP numbers that being captured, being recorded. So monthly retail sales since April that time is really start picking up. These are actually some of the very good indicators from the China side, which was the first epicenter of this COVID-19 outbreak. So on a quick glance on the major economics GDP, you can see that basically from now onwards until the first quarter 2021, you can see that most of the US country or Euro side are still expected to record a negative GDP growth. But you can see that on China side over here, China, despite what we call the COVID-19 cases, we can see that GDP is seeing a positive growth, suggesting that basically China anytime could just overtake US as the eyeball of the whole global economy. But that has to depends on how US gonna ride through this volatility going forward. But you can see that China is actually catching up quite fast in this. So moving on to the vaccine news. Some of you may just ask why should I go through vaccine news? Like I mentioned, it's to give you a sense on how soon will be the recovery and the expectation on stock markets going forward. As you can see over these slides. So another reason that I would like to touch on this vaccine is that basically it is what we call a prelude to what I'm gonna, what are the sectors that I will suggest to you going forward, despite a lot of noises. So on the updates on the COVID-19 vaccine development, you can see that there are at least 56 vaccines are the prominent vaccine players. They are currently ongoing. So over here, the vaccines. So I'm just capturing the prominent vaccines. They are going through the phase 3 of development, whereby you have Moderna, of course, you have Pfizer, CanSino Bio, Merck, Sinovac, Wuhan side, also as well as the last one. I can't remember what's the name of it. So just to give a sense that if there's any vaccines available here, they will only be as soon as second quarter. But bear in mind that whenever they came out with the timeline of the vaccine news, right, it's pretty much on the certain strains of viruses. If you actually caught up, if you actually follow the vaccines of virus news, right, you see that there are a lot of mutations right now. Some of it have become a super virus with a lot more faster outbreak that is happening around the whole world. So if you were to ask my humble opinion, I didn't think that effective vaccine will be available until not even until mid 2020. As you can see, that the mutation has been quite fast, and also because of the fast tracking, there are a lot of what we call backslash that come back. Just as an example, like the Oxford one recently, you can see that there are a lot of news on this, on the negative news on this side. Yeah. So expectation of the recovery. So even though some of the vaccine news already came out, but like I mentioned, these are pretty much depending, reliant on the vaccine is actually very much riding on the previous strains of viruses. So if there's any mutation, of course, the vaccine will continue to be dragged on. So if you were to ask me as to compare last time, I did went through with you what will be the recovery that we will see for the market next 6 to 1 year time. So of course we have V-shaped recovery, U-shaped, swatch, Z-shaped, W as well as L-shaped. So if you look at back then during the previous epidemics, you can see that in year 2002 we have SARS, we have H3N2, Asian flu as a Spanish flu, all were actually seeing a V-shaped recoveries. But then something is different over here. This virus, this COVID-19, as to compare with others, I personally do not think that it will be a V-shaped recovery, because back then the virus, do remember that it only happened to some of a minority as well as countries related epidemics. On top of that, also the spreading is not as fast, and back then globalization is also not as advanced as right now. So given the high mutation as well as outbreak as well, the way it spread, right? I personally do not think that it will be a V-shaped recovery, as you can already see right now. Yeah. So US market, an overview on the US stock market right now. You can see that that's a V-shaped recovery, but you can see that basically V-shaped recovery is melting. It could be a W-shaped recovery over here. So even Dow Jones also, you can see that Dow Jones is seeing a kangaroo market. So in terms of valuation, it's spiked up to +2 standard deviation over the past 10 years time, suggesting that if the economic recovery that will be anchored by the earnings of the companies does not come in, definitely they will be on the verge to come down again. So Nasdaq as well. But one thing about Nasdaq as well as the Dow Jones is that you can see that Dow Jones basically compared to the previous high level is still below that, but Nasdaq is actually higher than that because of the earnings expectation on the work from home culture as well as the growth that the Nasdaq components companies that are providing. So valuation is more than +2 standard deviation right now, and with the flush of liquidity out there, the market have nothing else to buy but only to a certain growth stocks and proxy that are benefiting from the COVID-19. So once again, on this one, so very much like you mentioned from the top-down approach, just a few key notable things over here that I'm trying to summarize over for you. So basically, IMF are predicting a deeper global recession due to the coronavirus pandemic. It seems like the case, confirmed by the US data. So whatever forecast that the markets are having is basically based on what I can see. But you can see that actually US right now is getting out of control because of the pandemic, and some other countries like UK have already implemented the second lockdown in view of the severity of this outbreak. So we're not going to go through each of these. Just want to tell you that basically right now, Wells Fargo estimates that basically market is turning into risk-off mode. If you were to follow the global news closely, also there are actually some money is actually flowing out from the US market into the safe haven assets like INCO, even some bonds that I mentioned over here. Yeah. So back home to Malaysia, still going to be a hazy outlook at least until 2021. What are the black swans or some of the wildcards that we have over here? You can see that business paralysis. Right after the auto moratorium being lifted, you can see that there will be more chapters of business closure being unfolded in the next few months. That's why our banker analysts, even though you can see the valuation of bank sectors are pretty cheap, but valuation, of course, is very much on the analyst expectation. But even the bank itself also couldn't give a clear view on how's the prospects going to be for the next 3 to 6 months, as they do not have a good view that already clouded by this moratorium. So rest assured that from top-down approach, from top-down basis, you can see that local economy is still going to be weak. From what I've mentioned to you just now, even looking at the US market, you can see that things are weakening. So second, cloud over here, you can see that ending of a low moratorium, you can see that liquidity, trading liquidity is actually sapping. In the next few slides, I'll show you on the relationship between the ACE market, on the small cap index, as well as the liquidity. That's actually a very strong correlation to that. Of course, the ending of a low moratorium will also could lead to a higher gross impact or loss ratio on that. So showing that the economy not going to be good. So back home, we also have our very own issue, which is the politics or the policy inertia. So they are mulling about the possibility of a snap election. They're going to pose further uncertainty from here. Policy rate cut will be in the limelight of it if the GIL ratio is going to pick up and the economy continue to slow down. Hence, the bank sectors still going to be quite challenging. So on the right hand side, you can see that we have a stimulus package that trying to help by the management, and then some priming from banks. Trade diversion over here. In the next few slides, I'll show with you comparatively to other sectors. Basically, exporters are seeing good growth as to compare with the typical old economics sectors, i.e. the plantation, the banks, and construction sectors. Yeah. So just going to go through very fast on this one. The measures are taken by the government. Of course, we have the MCO that have been implemented since March, and then thereafter RMCO on the 31st on December have been extended until the end of the year. So why I'm particularly I want to point out this slide is that you can see that back then when the government implemented the MCO, the impact that potentially hit the economy that have projected by this MAER, you can see that this could easily translate to negative 2.9% of real GDP growth of 2020 in relative to 2019, just over a month's time. And the number of losses could be in the region of 2 million. Of course, right now it's even higher. Household income projected for 12%, as such as that's why you can see that consumer spending is also in a sharp declining trends. So what I'm trying to tell you is that if you would ask me again, I hope that the government will not implement a nationwide MCO again, seeing such great disruption to the economy as to compare with other countries. Of course, our economy is more vulnerable to the shock from this pandemic. So measures being taken, besides of the rate cuts, fiscal policy and monetary policy, they also pump in higher liquidity in the market, hope that the internal spending will be able to stimulate the markets. So they also kept the interest rate low. So in terms of our market stock market performance, I did mention just now that basically in June that time we can see the euphoria in the market, and the strategy that we are advocating is actually on the more defensive approach, whereby we only go through the bottom up approach rather than a top down approach. So right now you can see the evaluation still back to past one standard deviation in just a few months time. So small cap index over here, wish to highlight to you that small cap index is this typical sector, like I mentioned, is very much participated by the retail investors. There's actually a very strong correlation, and if you would just to look at these slides, right? So small cap index performance very much depends on the volume of the participation by the small by the biggest investors. You can see that over here when it is at peak that time, right? Market small cap index actually peak, and when you can see that when the liquidity when the trading volume starts setting, actually you can see that there's not much support in the small cap index. So what I'm really trying to tell you is that as compared with last time, I would advocate retail investors to try to shy away from the small caps, because small caps, as you can see, some business even making losses, share price went up so high than was previous. So it was partly because of this one, like I mentioned, the stimulus packages with a record low interest rate, then the 6-month loan moratorium, the absence of short selling, the fear of missing out by funds, extended MCO, low economic activities, hence money can be put in the market, and halting of casino and NFO operations back then, as well as active participation by the operators. So in the next few slides, just to share with you that basically we observed that the liquidity from the retailers is actually start coming down, implying that basically the small cap or small cap stocks with no earnings are seeing what we call seeing a downside risk from here. So in terms of the sector performance, healthcare year to date up by 183%, and energy index down by 40%. So some of you may just ask me later on Bursa Malaysia Healthcare Index, the year to date performance is up 183%. So that's when you always tell me that we should buy low, sell high, and always go contrarian. So in next few slides, I'll show you on some of the things that you should take note of, which should give you a better idea of which sectors to continue to stay put. Yeah. So now looking at the trading volume in the Bursa market, Bursa Malaysia right now. So you can see that, like I mentioned, because of all these ample liquidity, you can see that it spiked up 10 years high. But on a closer look right now, you can see that trading volume, trading value is started to come down. So over here, you can see the local retail participation is started to come down. So one thing that you can basically, what can you observe over here? Yeah. So from our observation, over the past 3 to 4 months, there are a lot of retail participation, which are actually shown in the blue charts over here. You can see that local instant markets back then, some of them are trying to switch into the risk-off mode, selling all the tickets to the local retailers. But if you look at a closer look again right now, over the trading participation past few days, I'm pretty sure that you all can see that glove stocks actually inching up, but some other high alpha names or names are i.e. like tech, even the small caps actually start coming down. So just based on this chart alone, you can tell that the local retail participation is actually coming down. Just to quote an example, over the past 3 days, over the past 4 days, from what I observed, is that the retail participation, the retailers have really traded into net seller, but you can see that a lot of net buyers actually from the insti side. So question that you should ask yourself over the past few days, what are the stocks that have seen a lot of that have performed relatively well? So immediately you can think that basically glove sectors are actually benefiting from that. That's telling you that basically the ownership in glove has already changed hands from the retailers to the fund managers. So a couple of things that you should look before we jump into a strategy. So loan moratorium to end in a few days time. So basically funds, some of them they really lock in profit, but they are turning into risk on again. Risk on again, not into other high beta sectors, but in started to take position into glove again. So right now, you have more uncertainties from the global market. Of course, when we talk about this one, stock market is very much on the stock market performance have actually reflected the expectation of markets for the next 6 months to 1 year time. And given the case whereby right now more uncertainties to be unfold, I don't think I need to talk more about this. Basically, you should know that stock market will be more volatile going forward. We are still sticking to our defensive approach whereby we will go through a bottom up stock picks rather than a top down basis. So volatility, of course, in the interim, like I mentioned just now. So how should we position it right now? So our investment overview is that from our team, we think that by year end it should hit 1,600. But then again, given the current political uncertainty, we are actually looking to reassess again on this one. So 1,600 index target is packed on from the top-down approach, whereby we are extracting using a 21.5 times financial 20 PE, and also implying 16.4 times long-term mean PE. So if you look at bottom up, this is still considerably lower than our bottom up target of 1,674. So CI big components actually made up from telcos as well as banks as well as glove. So if you ask my view, diving deeper, glove should continue to see upside in terms of earnings. Banks, if you ask my view, basically I see some downside risk, downside earnings risk in banks, as mentioned by Keith also just now in his presentation, that even banks themselves also do not have any visibility on that. Hence, I will still advocate investors to shy away from banks for a while. Of course, it depends on the ability for you whether can you hold through this kind of volatility. At this juncture, still see uncertainty, but we will never know when is the bottom. So yeah, that's what I'm going to say right over here. So our key focus in terms of thematic play, we still stick on to beneficiary of COVID-19, whereas we have overweight cost still continue on the healthcare. Thereafter, we will talk about the trade direction related plays. So by taking a barbell approach, also our touch base on the defensive sectors. So last but not least, I'll also talk about the broader reopening theme. Of course, right now, this theme is not valid given the ongoing uncertainty. So typically, before I run into the strategy or outlook or sector picks, just to share with you on the sector rotation model over here. You can see that market is always react ahead of the earnings or the earnings recovery or the earnings weakness. Yeah. So so over here you can see that market bottom back then in March that time. Market bottom back then already start reflecting on the full recession. And when we went into the bull market in May after June that time, it's sort of like reflecting that the economy is actually in the midst of a recovery. And right now, fast forward to on hindsight, fast forward to June and July, market is actually topish, reflecting that with expectation that the economy will go through a full recovery. So right now we are actually somewhere around here. So if you to ask me, somewhere around here, basically market is on the downtrend, seeing that there could be a weakness again in 3 to 6 months time. Basically saying that the recovery is coming in slower than expected. Yeah. So things are slightly different with COVID-19 right now. So these are the investment strategy in terms of timing, but of course, wish to touch on that. We wish to highlight that basically no one can ever time the market perfectly. So this is actually our hypothetical scenario in terms of the investment strategy. So stage 1, second quarter to third quarter, fear of a COVID-19 relapse, sectors to look out for is actually telco, consumer tech, office, REITs, as well as gaming. But of course, gaming doesn't turn out to be as good because of the ongoing bailout issue from the parent companies itself. So stage 2 expected to be fourth quarter, but right now, I personally think that this has been pushed behind. Potentially could be as early as the first quarter 2021. So sectors to look at will be aviation, oil and gas, but that will be 6 months or even 9 months later. Right now, like I mentioned, being pushed behind. So these are the sectors that you should look at. So I put it in the chart itself. You can see over here, right, fourth quarter 2020 instead of fourth quarter right now because of the outbreak. As well as the slower than expected vaccine, it looks like the strategy for fourth quarter will be pushed to either first half of 2020 or slightly later than that. On that, so in terms of investment style, we should actually look at the cyclical recoveries, i.e. Oil and gas, plantation, gaming, banking, as well as aviation. So we are actually still at the third quarter revisiting of an economic pharma, even though we are going to close our chapter for the third quarter soon, but I think the third quarter strategy will spill over into fourth quarter in view of the outbreak right now. So sectors to look at will still be very much on the glove for its growth and beneficiary of COVID-19. We have utility as well as telco as defensiveness, then bottom-up yielders, and of course, some of the selective tech names. So investment style will be a barbell approach, but we will have a mixture of defensive yielders as well as growth. So over here, strategy ambition for second half for you all. Basically, we like growth sectors that will continue to give good earnings visibility even though with the COVID-19 outbreak. So some defensive names, business, they are still seeing some inelastic demand. Border reopening will be more later than will be later on. So as you can see over here, basically we did not put in any value play. So to us, right, some value play, if you do not have any earnings visibility, anything that you invest will be a value trap unless you can hold it through. But bear in mind that every money that you put in or invest, there's an opportunity cost. So that's why you need to look at the best sectors that can give you alpha, that can give you growth to invest in. Yeah. So strategy ambition for second half 2020, we have rubber glove, still on rubber glove. I will share with you on the reason why we are still into rubber glove sectors as to vis-a-vis the other foreign banks. They are actually advocating a sell call on one of the big player in the glove space. So we also have the trade diversion place, of which we have furniture, but furniture of which Jack will go through with you later. It's very much an opportunistic trade. Okay, mark my word, opportunistic trade means that actually these sectors could be cyclical. So in terms of positioning, you need to be really fast, and it will be on a trading approach on the furniture page. So we, of course, we also have some of the selective tech names, even though in view of the weakening of our Nasdaq valuation. So in terms of defensiveness, we have a bottom-up approach on the defensive business model. Then new place with resilient business. Thereafter, border reopening team. This, like I mentioned, will be later on, not anytime soon. Yeah, just to give you a sense on this one. So in terms of rubber glove, demand estimated to continue to grow by 8 to 10% per annum. 13, just to give you a sense, 13 years CAGR over the past 10 years, so it will be 9.2% by then. So glove demand expected to grow to 330. Thereafter, therefore, heading into 2021, volume to grow substantially before hitting a lull in 2022. Yeah. So in terms of average selling price, it's still going through an uptrend. So from what we gather right now, I think some of the what we call latex glove, some of it could be selling at as high as basically the gap is already closed up to with the nitrile glove. Nitrile, we are talking about at least 100 to 150, depends on the seller, but as far as I know of, actually selling close to $150 per 1,000 pieces. Latex is also close up the gap, and hence we can see that for any players with a lot of interest of latex as a nitrile will continue to benefit from this trend. Yeah. So one key points over here. So basically throughout 2021, we expect the lofty average selling price to be maintained because currently from what we can see, inventory levels at the European countries and US only barely meet existing demand, whereas backlog orders, some of the companies reveal that it could be as high as 620 days, basically as good as 2 years time, suggesting that basically the demand will continue to go up. Supply also takes time to come in, hence average selling price should maintain at the current high level. Yeah. So meanwhile, if we look at the cost is expected to remain sluggish. But then again, if you look at the nitrile prices, it's expected to trend up due to the high glove demand usage. But bear in mind, even though there's a spike of the raw material costs, you can see the average selling price is actually much more comfortable to actually offset the cost on this side. So cost is, to me, is actually not an issue, at least for the next 1 year. So production capacity, too small to look at, so I'll just really jump to this one. But the production capacity, like I mentioned, 330 billion, Malaysia taking a huge share of it. So just to give you a sense, utilization right now, all of their current utilization rate is more than 95% and more than one shift. And the production capacity, top gloves still remain the highest among all, whereas they have a good mixture of latex as well as a nitrile. Vinyl as a surgery looks like, just from this graph alone, you can tell that basically top glove will be the one that benefit the most in terms of prices. Like I mentioned, latex average selling price have already closed up the gap with nitrile. And then if you were to look at the nitrile glove from top glove, right? Nitrile 35% times 60.5, and you look at the Hartalega 96% times 32 billion. So production capacity in nitrile, the surgery, the surgeon, the medical grade glove, right? Both of the top glove and Hartalega is actually very much on the same volume. But valuation on Harta is actually slightly catching up ahead of our top glove, and at the same time, latex now closing the gap, implying that top glove actually earnings from top glove will continue to see a lot of upside from here. So assumptions from our analyst Philip, I think he already mentioned about this last month during our presentation on tech as well as healthcare, but just to like to reiterate things that average to pick in early 2021, followed by average to be maintained for the remainder 2021. So the good indication is if the average selling price will take in early 2021, right now we are talking blended average selling price is already at 100. There are actually still room from here. So market actually have not factored that in. That explains why you can see that retailers seeing some shock, they throw out the glove stocks, but right now fund managers, even for the lack of ETF, started to take position in. That tells you what? that tells you that basically the earnings on the glove could be higher than expected. If some of these companies give out special dividend, you can see that the special dividend could be quite enormous. So just wish to highlight that part, yeah. So are there some of the risks that you should take note of course, on the rumors on the windfall tax, but we do not think that it will be windfall tax anytime soon. Influx of China capacity. Most of the question that we got from fund managers is actually on the supply side, whereby if there are more supply, of course, every selling price will come down, right? But you can see that Blue Seal as well as International Company of Medical from China side will add the 89.6 billion pieces of nitrile glove. But then again, that will only by end of 2023. Yeah. So in the interim, what you can say that basically average selling price will continue to go up. High demand from the Euro as well as US side will continue to provide a cushion for the average selling price to come down. So our take is totally opposite of another foreign fund, another Australian-based foreign brokerage. Basically, we still overweight on this, seeing a few key catalysts that do sustain at least for the next 6 months to 1 year. Yeah. So topic for the sector, we still like Top Glove. So Top Glove, how we actually position our earnings is that come up with our target of 12 ringgit 30 cents. We are actually using just 13 times 121 PE. So just to give you a sense, at normal time, Top Glove is trading at mean of 25 times. So here, 13 times of 2021. Okay, if you look at the earnings, yeah, over here is a bit small to look at, but if you look at financial 22, PE at the current share price of 8 ringgit, close to 9 ringgit, right? The PE is actually at 21.5 times. So in year 2022, at year 2022, actually, Philip is putting in a very conservative average selling price. So that's basically provide one cushion as a margin of safety. So like I mentioned, during normal time, the average PE is 25 times. So if you assume that 2022 will really come down to this level at 3 billion, but right now it's only at trading at 21.5 times. So basically that tells you that over here, they imply another 20% more upside, just based on the conservative PE in the normalization year, which is in 2022. Yeah. So that tells you that even though just ascribe 13 times, the big valuation discount is actually due to the super cycle earnings growth. We expect the price to catalyze the valuations that will be supported by a decent dividend yield. Yeah. So glove assumption. So just to give a sense, right now, average selling price Philip assumption is actually at 70 over dollar. Blue sky scenario, if the average selling price could inch up to $100 per 1,000 pieces, by just ascribing at 10 times PE of the earnings will, the target price will be at 19.80 cents. Of course, we are not what we call ambitious to ascribe these kind of things. So Philip is actually taking a very conservative view by just ascribing 13 times average selling price of 70 US dollar per 1,000 pieces. The target price will be at 12.30. Yeah. So for the rest as well, Tata Nagel versus Fosun. So Kiwi's discovery of vaccine treatment caused a negative news flow, but however, scaling of global manufacturing to achieve herd immunity may take up to 12 months and beyond. So at this Kiwi's, like I mentioned, the things that I mentioned to you just now, looking at the timeline of vaccine, and right now, vaccines are seeing a lot further. Looks like the Kiwi's on the vaccine is no longer as appealing as to compare with last time. And that explains why the investability of glove in terms of expectation is getting better. Yeah. So other risks to include is actually on the raw material cost as well as strengthening ringgit, sharp ASP reversion as well as COVID-19 outbreak among the production workforce. So before jumping into the other sectors, we're going to pass on the mic. We're going to pass on the mic to Jack, our gaming and furniture analyst.
Hi, good morning everyone. I'm Jack from UOB Kay Hian. Today I would like to share with you about another clear beneficiary of US-China trade tension, which causes spillover of demand from China to Malaysia, the furniture and the particle board sector. So unlike your glove, tech and healthcare stocks, furniture-related stocks are kind of low profile and not under the limelight. However, these stocks actually outperform the market significantly. Malaysia is a mature furniture manufacturing country with sales and market share uptrending year on year, and this has been accelerating since US imposed tariff on China products during the trade war, including the 35% tariff on furniture products. As a result, if you look at this slide, Malaysia furniture export to US have recorded a 39% year-on-year increase in 2019, and this provided a full opportunity to furniture companies with export exposure to US market. To add on, China used to be the biggest exporter of furniture to the US, shipping around $34 billion worth of furniture products in 2018. So moving forward, we expect further spillover of order books from China to emerging countries such as Malaysia due to the trade uncertainty. We wanted to highlight a few catalysts of the furniture sector, including this structural demand shift as US-China trade war extends. Besides, as we know, due to COVID-19, right, especially in US and Europe countries where the cases are still very high, a lot of companies started practicing this work from home trend. So last time when we work at office, we spend very less time at home, right? So we didn't buy so much furniture. But now spending whole day at home and having video call meetings, people started buying more furniture so that the house looks good. Also, governments everywhere are giving out a lot of fiscal stimulus, similar to Malaysia's Bantuan PRT, and it comes at a huge amount. As a result, if you look at the statistics, furniture sales in US and Europe countries are very robust and hitting a very strong demand. This actually translates into better earnings for Malaysia furniture companies with export exposure. We also talked to a few listed furniture companies, and they were all saying that order books are coming strong and their factories running at high capacity to fulfill these overwhelming demands. So we move on to the next slides. Okay, moving on to some key statistics of the industry. This chart, right, it shows the new home sales in US. The latest data just came out yesterday, and we can see that the US new home sales have been going up significantly to higher than pre-COVID level. And the September home sales is the highest since 2006. This shows that the sentiment in US is very resilient, and with more homes sold, this will continue to stimulate and lift demand of wooden furniture. From the three charts at the bottom, you can see that actually since 2018, after the US-China trade war, the net profit and margin trend of furniture companies have been trending up. And to complement the US dollar and ringgit exchange rate, it's a high level in 2019 and 2020 compared to 2018. So you can see US dollar has been hovers above 4 ringgit, went up to even above 4.4 in 2020 earlier. While COVID-19 undoubtedly affected their earnings in first half of 2020, that's why you see the net profit margin and the net profits coming down. We expect a strong earnings rebound in the third and fourth quarter this year due to overwhelming order books. So in Malaysia, there are some of the furniture companies listed in Bursa. I'm sure you all surely heard about these names, including your Lihan, Latitude, Pohuat, Homebreeze, and Webmans. So these companies, they export most of their products to US, Canada, and Europe. Except Webman, you can see that the valuation of the furniture companies are still relatively cheap at 8 to 12 times current PE, and dividend yield up to 5%. To complement, most of the furniture companies are net cash companies with a lot of cash in hand, as shown in the table. So year to date, furniture shares have been bashed down due to COVID-19 and lockdown, but we can see it is a V-shaped recovery that since March, the share price have rebounded strongly to even higher than pre-MCO levels. Is there still more upside? We think that when the earnings come out strongly and sustainable strong order growth from US and Europe customers due to trade war, furniture stocks should still have more upside in the future. From our perspective, since furniture stocks are doing so well, but share price have went up so much, are there any other sectors benefiting from this? If we further do some analysis to the whole value chain, furniture manufacturing requires a lot of particle board, and the particle board sector is set to benefit from a demand surge from local furniture players. We understand that some of the particle board players in Malaysia, such as Mieco and Hira, are also seeing overwhelming order book since MCO is lifted. I recently talked to the management. Their production lines are running close to 80 to 90% of utilization rate to capture these demand spikes. So shortage of particle board in the market to fuel the demand also prompted the selling price for chipboards to surge about 15 to 25% from pre-MCO level, which implies a much higher margin and better earnings for these companies. Also, their major cost component of particle board manufacturers, such as glue costs, which is about 33% of total cost, have been coming down significantly due to lower crude oil price. We covered Mieco and Hira and initiated a buy call for Mieco at 34 cents and Hira at 49 cents respectively. While share price have moved up, we think that there are still more upside to Mieco due to their production mix and higher ASP. For more details, you can actually access our furniture report published on September from our U-Trade portal. If you haven't yet an account, you can contact our reminders or operating staff to register a new one. So we'll pass on the mic back to Desmond for okay. So to further elaborate while we are waiting for Desmond to come back on the trade diversion piece, I would also like to highlight Mieco chipboards. Due to their so what do we see in Mieco chipboards that's so attractive? This is actually because of their production mix. So as you know, chipboard companies, they manufacture E1, E2, EC, and EO boards. So before this, Mieco was manufacturing more of E1 boards with lower margin, but then due to the strong demand from all these furniture companies, right, actually they have shifted their production mix to more of EO boards, and this should translate into higher earnings in coming quarters. So we'll pass on the mic to Desmond for the trade diversion points.
Thanks very much for presentation, Jack. So I believe you all have a better idea. One of mentioned by Jack is the opportunistic trade. Yeah, just not my word again, opportunistic trade. So the earnings might not last as long, but at least for the next few quarters, we can at least see a strong earnings from that side. Yeah. So moving on, another trade diversion related sectors that will be benefiting from the COVID-19 pandemic, or relatively shield, I would say, from COVID-19. So of course we have a tech sector whereby highlights is that US and China trade will continue to put the halt on the sector, but will we not, because going forward earnings are still pretty good. So things that you should look out for is the severity of COVID-19 outbreak. This could be WHO sort for the group. One thing is that people could work from home. The other thing is that or using more virtual meetings, right? So we'll continue to drive up the virtual usage. But on the other hand, COVID-19 outbreak, if it is severe, it might affect some manufacturing capabilities for those tech players that will require a lot of favors. So escalating of US and China trade war, of course, is one thing to watch out for. So in terms of catalysts, on top of this 5G and higher digital transformation, you also have the acceleration of MNC players expansion in Malaysia, and you also intensifying order diversion from MNC production. So basically, you can see that these pointers tells you that Malaysia will continue to benefit from trade diversion trends. Yeah. So in our topics, we like Greattech, Pentamasters, VS Industry. Greattech very much on the exposure on the EVs, as well as the automation solution. Meanwhile, for Pentamasters, similarly, Pentamaster is more towards the Apple as well as smartphone as well, telecommunication based installation, whereas VS Industry among all the EMS players will be the champion among the EMS. Yeah. So key trends to look out for: commercialization of 5G potential winners. We have Inari, MPI, Unison. Whereas on the evolution in automotive space, we have MPI, Unison, KSM, and others such as JHM. The industrial automation and industry 4.0, we have Victrox, Pentamaster, Greattech. Whereas on the vector application, the light technology, we have Group-Tronics, Inari, Alsoft, and MSV. Why I particularly list down this one? Because just as a practice, right? If you were to invest in any stocks, one of the points that you should ask yourself: what are the catalysts or what are the trends that you are investing for? Then you should by going this kind of practice, basically you will have a better idea what to look out as a winners for the next few quarters. Yeah. So technology sector is still being overweight. Like I mentioned, we like Greattech, Pentamaster, as well as VS. Of course, if you look at the other stocks, also stocks that we do not we wish to highlight, such as Greattech, Penta, VS, right? We have MPI. MPI is actually the way you look at MPI is that they actually have one new technology, whereas they're actually doing a silicon carbide, a new material packaging for the high power related industries, i.e. the what we call the 5G, big data, as well as automotive. So this could be the key winner for MPI in the next few years' time. So the other players also, we like StormNet. Basically, StormNet is a direct beneficiary with COVID-19 related medical devices. Just to give you a sense, their customer is actually Ambu, Mermaids, and these are the world-class medical players in US versus Euro side coming out with healthcare equipment. So just to give you a sense, StormNet participating in the R&D with the end customers are actually coming out with the consumable products for IE, like disposable bronchoscope, as well as the intensive ICU monitoring cables. They are widely used in the first line of lung treatment for patients that are suspended and confirmed COVID-19 infections. So at this level, if you look at the forward PE as for 2 years forward PE, okay, forward PE for financial 20 is actually relatively expensive, 43 times. But of course, when you buy stock, buy the growth prospect in the future, right? So in 2 years' time, you can see that basically not 2 years' time, right? You can see that in 1 year and 1 quarter time, the earnings will normalize from 43 times to 25 times, implying that basically there are a lot of growth in StormNet. So this is actually an underappreciated stocks. You can actually put that into your portfolio as to monitor that. So like I mentioned just now, we went through the barbell approach. Besides giving you growth, besides giving you beneficial COVID-19, we also give you some options for stocks to hide in terms of volatility. So defensiveness, NQREITs, Nanakoff, Tenaga, Top Glove, and Magnum. Why NQREITs? Basically, besides on the high yield, the business model is actually more invulnerable to COVID-19 because their portfolio is actually in the office spaces. So office spaces are still seeing high demand as well as occupancy, hence they can be able to what we call continue to pay out decent dividend. So Malakoff, Tenaga is very much a power. We all know that monopoly play and elastic guys. So this will be the player. Of course, all this is for the big cap guys, right? So Top Glove, I won't mention in details again. So basically, they are seeing the best ASP revision beneficiary. Like I mentioned, the gap from latex versus nitrile already close up. You can see that the blended average selling price will continue to uplift their margin at least for a few quarters. Even looking at financial 22 on the normalized earnings, implied PE currently at the current share price is 21 times. 21 times, like I mentioned, normal time they are trading at 25 times, implying that they are another 20% more at least for the current upside. I do not know how will be the price reaction but what I can tell you is that the earnings are actually relatively good, and we all know that stock markets is like a weighing machine in long term and a voting machine in short terms. It's already proven to you from June to September right now. You can actually look at this. Then Magnum, why we like to do Magnum? Because of resumption from the MCO temporary closure, very cash-rich business, and then people are still buying lucky draw, so relatively stable as compared with other players. You notice that in terms of defensiveness, we haven't put Genting or any other stocks. So it will be under the border reopening team later on, whereby on BAT, we have BAT, Genting Malaysia, Heineken, as well as Pavilion REITs. So BAT basically coming from the cost savings from restructuring, resumption of duty-free. Another thing is that you look at the dividend, it's actually at 8%, relatively high. And the way you look at Genting Malaysia is that the worst or closing to the worst have been pricing it at this level. It's already trading at relatively low level, but the concern is actually still very much on the bailing out of the parent company to some small subsidy or some small segment. So without any new visitors, actually the earnings still going to be lackluster for a while. But that's very much on how you look at the PE itself, right? Genting growth itself at PE is already at 9 times, and 2-year forward is 7 times. There are pretty much uncertainty in the business, but rest assured that very much of that has been priced in. And now it depends on how long will be the border reopening. Definitely stocks to look at for Genting as well as Genting Malaysia. So Heineken, when the border started to reopen, of course, it will boost the overall alcohol consumption, especially with Heineken, because of the franchise that they have as compared with others. Yeah. So last but not least, we have Pavilion REITs. As you can see, if Pavilion REITs is very much the earnings are premised on the occupancy in terms of retailers in the pavilion itself. So if the foot traffic will continue to increase, so definitely there are more shops to open. So it's actually another proxy as a key investor booster for the reopening team. So we'll stop here.